Well, the latest Adcorp Employment Index has shown an unchanged employment scenario for February. According to the index, an increase in informal jobs of 11,207 was countered by a decrease in the formal sector, which led to the static nature. Joining us now for further analysis of the index is Adcorp labour economist Lone Sharp. Lone, thanks so much for joining us today. Well, an unchanged employment scenario, as I've highlighted, a static picture, not encouraging, but one would assume not entirely surprising either.
Yeah, it's not surprising. The economy is in a very weak condition. Bear in mind, the economy needs to grow 4 to 5% per annum just to absorb the matriculants who come out of the schooling system every year. The economy needs to grow 8 to 9% per annum to make any significant inroads on unemployment. So it is a very weak picture. The labour market is reflecting the weakness in the underlying economy, but there's a very mixed picture from a sectoral point of view. Mining and construction employment was down sharply, but that was offset by employment by government and transport, which was up quite sharply. So there's a very definite sectoral story behind the employment figures.
Not only a sectoral story, but a story about who exactly is being employed, because we highlighted in that introduction that we're seeing an increase in informal jobs and a decrease in the formal sector. But having said that, this report has also revealed that we're seeing an increase in high-skilled jobs. I mean, that remained an overwhelming source of employment creation over the period.
We're seeing more and more a disconnect between the highest skilled workers who command the highest wages and premiums, and the informal economy, the lowest skilled workers who cannot get into the formal sector. So there's an incredibly stretched relationship between those two. And of course that's driving inequality, because the highest skilled people's wages is rising about 16% per annum, and wages for unskilled people are very much static.
What exactly is that telling you about our employment context right now?
It means that there's a competition for skills in South Africa. The part of the economy that's growing and creating jobs is the tertiary sector, finance, business services, transport, communications, and those areas, the high-tech areas of the economy. And the part of the economy that's under substantial strain is the old-fashioned primary and secondary sectors, manufacturing, mining, construction. So the economy is undergoing a dramatic reorientation toward high skills, and people who are coming out of the schooling system are being left behind because they don't have skills.
Mm-hmm. Does that surprise you, given how many times we've spoken about the rigid labour law that employers face in South Africa right now? In fact, that being cited as the major reason for why we're seeing an increase in informal jobs as opposed to in the formal space.
I think what's happening in the informal sector is that small companies, remember, companies employing less than 50 people account for 2/3 of total employment in the country. And those businesses have many opportunities to evade income taxes, avoid labour laws and regulations. So we're seeing the small business sector of the economy disintegrate into the informal sector, and non-compliance with labour laws is a big reason for that growth. The two labour laws that are most problematic, that most of our clients cite in their job creation plans, is dismissal protections. Mm-hmm. Workers are overly protected against dismissals, especially for poor performance. And also our wage system promotes relentless increases in wages, irrespective of productivity, irrespective of on-the-job performance. So those are the two things that our clients state as highly problematic among the labour laws.
Mm-hmm. Having said all of that, an interesting concept that you highlight in this month's report is the wage share concept, and what that's telling us about trends within this employment scenario right now. Give us some detail on that. What exactly are we looking at, first of all, when we look at wage share?
The wage share, if you imagine national income as a pie, then wages is one slice of that pie. The other incomes that people can receive, so for example, rentals in the form of loan owners, profits in the form of shareholders, all of these things make up national income. The wage share is traditionally in most economies the single biggest share. That's what workers get out of the national income. But that figure has been declining dramatically. So where 20 years ago workers had 60% of national income, they now only have 50%, and it's falling very rapidly. So labour's share of the total economic pie in South Africa has been declining. There are several reasons for that. The first is that profits, which make up most of the balance in relation to wages, profits have been very strong in South Africa. In many respects, our private sector is among the best functioning in the world. So for example, a recent report indicated that South Africa's listed companies have a risk-adjusted return, a real return of 10% per annum, which is currently the highest in the world. And that's driving profits up and wages down. But also from a wage perspective, productivity is really under pressure. We've seen productivity at a 46-year low, and therefore wages share of national income is at a 50-year low.
Mm-hmm. One could also assume that it's as a result of this trend we're seeing in informal and formal employment, because if you've got companies employing informally more so, so your temporary workers, that comes with a much lower fixed cost base, one would assume.
Absolutely. This is a long-term trend. It's been in place since the LRA was introduced in 1995. We've seen dramatic growth of temporary staffing. And this is not only small employers, but also large employers who are trying to get away from the perks that are so costly. So very few companies left in South Africa that pay pension fund benefits or medical aid benefits. In fact, only a third of South African workers have a pension fund and a medical aid. So these benefits are becoming increasingly scarce, and more companies, even with their permanent employees, are using a cost-to-company model where you decide, but the company limits its exposure to you as an individual to the cost-to-company.
How do you see this contributing to the wage demand argument moving forward, what employees are now asking for?
Yeah, I think more and more the wage increases that we've seen have been broad-based, in the sense that 15 years ago, wage demands related to wages alone. But now we're seeing trade unions, bargaining councils become much more assertive around a much broader range of issues for companies. So standards of living, the cost of living, these are sorts of things that companies now need to factor into their wage increases. And what that's driving them to do ultimately is to mechanize and automate, really to avoid the use of labor altogether. It now takes 36% fewer workers to produce a level of output than it did in 1960 in South Africa. So there's been a tremendous amount of mechanization over the last half century.